Caution! Few investors capture or exceed the market returns. And again, we're revisiting John Bogle's article, John Bogle, RIP, from the Journal for Portfolio Management in fall of 2015. They had co-written with a guy named Michael Nolan Jr. And I did the first video on this just a second ago where he kind of talked about projections for future returns. And he's basically saying about a 4% rate of return for stocks and bonds, a 50-50 portfolio for the next, for the foreseeable future, which is going to make this, what I'm getting ready to share with you, even that much more dastardly. All of the data in the article has focused on past returns of the U.S. stock and bond markets. These returns, however, are not the returns that investors actually receive. As a group, all investors must and do earn the gross returns provided by our financial markets. They must incur the costs. They must also incur the cost of buying, holding, trading those securities, as well as the cost of investment advice, administrative, and marketing, that permeate the system. In his study of the all-in expenses incurred by the mutual fund industry, a 2014 article, The Arithmetic of the All-In Expenses, Bogle estimated that the annual cost for the average actively managed mutual fund was 1.1% for expense ratio, cash drag of 0.15 because it was never fully invested the whole way, portfolio turnover of 0.5%, and sales load and fees to registered investment advisors of another 0.5%, so a total cost of 2.27. So let me show you what that means on the board here. All right. So we have the market. It gives us 10%. All right. Now we have Joe Smarty Pants. 12%. So what does Joe Loser get? You want to guess? All right. So Joe Smarty Pants got 12. The market gave us 10. So inherently Joe Loser gets 8. All right, because that's the market. The market is these two guys. I mean, it's literally that's it. And that's no different than you and me and everybody combined. The market is every single individual investor out there. There's no other way around that. So we combine these two, and we got 12 plus 8 equals 10, or 20. Divide by 2 people in the market, and that's a 10% rate of return. All right, now watch what happens next, though. So remember, Bogle said we're paying about we'll just say for simplicity, 2% fees. Just 2.27 to make it harder for me to navigate off the top of my head because I don't have that kind of genius brain. Oops, I just dropped my stuff there. All right, so we got Joe Smarty. $12. We got the market. 10. And we got Joe Loser. 8. However, Joe Smarty costs 2% and Joe Loser costs 2% because the market is solely the before fee return. So before fees, before expenses, the market is 10. But now we factor in the 2% that these guys charge. Now Joe Smart just equals the market and Joe Loser is now at 6%. So Joe Loser is now 40% behind market. Joe Smarty, though, is just at the market because his fees are eaten away. This is before taxes, by the way. You factor in taxes, it's going to be even worse. And so what happens here is the market is the net or the gross return of all players in there, but then you have to factor the net return. That's the only thing that matters, my friends. What do you actually receive for the risk that you're taking? And the actual thing you're receiving here is 10% in the market. So there's a 1 of 2 chance. You got one guy who did better, one guy that did worse than the market. The guy who did better did 20% better. The guy who did worse did 20% worse. And so you roll the dice and you want to be Joe Smart. But you say, well, at the end of the day, after fees, Joe Smart only gave me market-like returns with all the risk I'm taking. And is that worth it? And then even worse, if you're a Joe Loser, you're 40% behind. So the whole point is to eliminate this 2% and just be the market. Say, I'm going to be a combination of Joe Smarty and Joe Loser, and I'm going to reduce my fees to know for a fact that I will get the market returns. Both these guys cannot beat the market. It's inherently mathematically impossible that they can both beat the market. It cannot happen. I mean, it could be significantly higher. Joe Smarty, he's just basing him. If he's going to be higher than the market, it's literally a taking from Joe Loser. Nothing inherently wrong with that. But you don't know if Joe Smarty is going to be better, or we just have no idea. Nothing inherently wrong with thinking that Joe Smarty is going to be way up here. But just remember, if there's one guy who's way up here and the market's down here, there's got to be a guy on the other side of the trade. Who's that guy on the other side of the trade? We don't know. But we do know that when you after factor in fees, Joe Smarty becomes to look a whole lot less smart, and Joe Loser becomes to look a whole lot more stupid. And that's what happens, because you're like, look, we gave you the market, and I took all this risk, and I paid all these fees, and you're just giving me market-like returns, Joe Smarty? And the question is, can he do it consistently? Could there be a time where Joe Loser becomes Joe Smarty, and Joe Smarty comes down here? And the answer is yes, absolutely. So that's why I just do the market, because, you know, if you do the market, you get the market returns, net of fees, because the fees are nothing for the index fund. I mean, tiny, tiny. All right, let's see. We talked about taking known fund costs into account and estimating others and adjusting for taxes for taxable investors. The 4% gross annual return on the 50-50 portfolio that Bogle forecasts, and we talked about that last episode, could easily be slashed to 1 or even nothing depending on the fees and tax that you paid. Essentially, you're going to lose. You could lose significantly, 50% or more of your total gross returns by fees and taxes. It's nuts. I do want to talk about this. What about stock buybacks? I'm actually a pretty fan of this. In recent years, it's been argued that corporations' buybacks of their own shares is a new form of dividends that return cash to shareholders. In the abstract, because total earnings are divided by a smaller number of shares outstanding, share repurchases should enhance earnings per share. What seems like a simple proposition, however, proves to be anything but simple. The record is clear that companies have little insight in effectively timing their share repurchases. Indeed, at the 1999 stock market peak, total corporations' share repurchases reached a record high of 7.2% of total shares outstanding, only to fall to less than 1% in 2000 and to 0 in 2001 as stock prices tumbled. So, in 1999, the mark is way up here, completely bubble area. A record high 7.2% of total shares outstanding were repurchased by the smartest guys around, the CEOs of these companies. In 2001, when the markets were way down here, there were basically no shares repurchased whatsoever. Would you rather buy back your shares when they were up here or when they're down there? You'd rather buy back when they're down here, and yet no one did that. One thing is they didn't have any cash. As Warren Buffett said in 2011, Charlie Munger and I favor repurchases when a company's stock is selling at a material discount to the company's intrinsic business value, conservatively estimated. Buffett goes on to say, the first law of capital allocation is that what is smart at one price is dumb at another. Yeah, I agree with 100%. So the idea of these stock repurchases, if you're buying it at a 45 PE when you could have waited 18 months and bought it at a 15 PE, a dumb move. You should not have done that. You waste cash. You use equity that could have gone to something other thing, buying other companies, for instance, that have a trading way down. All right, see, some benefits of the Bogle model. One of the model's major assets is that with its 10-year time horizon, it emphasizes the need for investors to focus on the long term. Focusing on the short term is the business of speculators. For the momentary movement of stock prices is, in Shakespearean terms, a tale told by an idiot full of sound and fury and signifying nothing. Another major point of the Bogle model is that it shifts investors' focus away from historical stock and bond returns and toward the future. When we shift our focus to the sources of stock and bond returns, expectations for future returns are demonstrably more accurate. For example, history tells us that the long-term dividend yield on stocks has been 4.5. The current yield on stocks is 2. The 2.5 percentage points reduction in of itself calls for more cautious expectations for stock returns in the years ahead. Another benefit is market strategists who now forecast with carefree abandon stock returns in the coming year or two of, say, 12%, could be anything, will be pressured not merely to guess at a single number, but to cite the sources for the returns. The dividend yield, the earnings growth, and the change in PE multiples. A conservative, disciplined investors will, we believe, come to demand. A constructive discipline that investors will come to demand, we believe. And they're just saying, look, you're going to give us 12% rate of return, Dave Ramsey. Where are you getting that from? You got dividend yield, earnings growth, and change in PE. PE is already high, so I wouldn't expect you to think the PEs go from 30 to 40. That would be crazy. So earnings growth can go through the roof. I mean, you might love the Trumpster. Hey, more power to you. Are we actually anticipating that earnings growth are going to double and triple? Finally, the clear separation between investment return and speculative return would bring greater rationality to discussions of returns in the bond and stock markets. Even better, money managers might begin to focus on the long term, supplying the market with a demand for securities that is steady, sophisticated, enlightened, and analytical, focused more on a corporation's long-term intrinsic value than a stock's momentarily stock price. It is at least possible that Bogle's expectation of the dominance of enterprise over speculation, expressed again in the quotation from his 1951 college thesis, will at last begin to permeate our financial markets. Yes, in the years that followed his thesis, his hopes proved completely wrong-headed, but investors have paid a costly penalty for ignoring his philosophy, and investment management professionals are learning the hard way from the experience, i.e. waste a lot of money chasing markets in a goal of speculation. Don't do that. Intrinsic value. Price, your dividend, current dividend yield, plus the growth of earnings. That's what you look at. Everything else is speculation. You cannot predict speculation. It's just a crapshoot. So look at the intrinsic value, get rid of speculation, reduce your fees, follow the market, buy the market, and you're going to be good to go. That's all there is to it. All right, we'll see you next time.